Many people have been looking for rate cuts, but now it's actually looking like interest rate hikes are going to be more probable. I'm Ron Sneller, certified financial fiduciary and investment advisor representative. The U.S. Federal Reserve will meet once again in about 2 weeks here, where new chairman Kevin Warsh will take the helm for the first time. While the Fed has kept interest rates steady so far throughout 2026, there is far from a consensus among the group. The last meeting in April witnessed the largest number of dissenters in 30 years. As the war in Iran continues into its 4th month, sentiment around the Fed's next move and when the move will be made has changed significantly. The market has completely turned face on its short-term interest rate expectations, moving from expectations of 2 rate cuts in 2026 to now penciling in a rate hike by the end of the year. Let's take a look at market rate expectations, inflation, and the money supply. But before we get rolling, I'd like to thank our friends over at First Trust Advisors LP in putting this information together for us to share with you. For more information like this, follow Brian S. Westbury, Chief Economist at First Trust, and Robert Stein, Deputy Chief Economist. Now let's get into it. What you're looking at right now is the CME FedWatch Tool, which is one of the most widely followed gauges of market expectations for Federal Reserve policy. Using pricing from 30-day federal funds futures contracts traded on the Chicago Mercantile Exchange, it calculates the implied probability of federal funds interest rate changes at the upcoming FOMC meetings. As of yesterday, markets were pricing in at least 1 rate hike by year end, with rates expected to remain at higher levels throughout 2027. That marks a dramatic shift from the beginning of the year when investors were expecting the Fed to deliver 2 rate cuts. Part of the Fed's dual mandate is to ensure stable prices in the U.S. economy, which it defines as keeping overall inflation at about a 2% target. While inflation was slowly trending towards this target to start the year, the war in Iran and subsequent closure of the Strait of Hormuz pushed fuel oil prices 54% higher, causing the CPI, or the Consumer Price Index, to rise sharply over the past 2 months. The good news is that prices for other goods and services in the CPI have remained subdued, although prolonged increases in energy prices can spill over into other areas of the economy. History tells us that persistent inflation stems from monetary conditions rather than temporary supply disruptions. Now let's take a look at this chart of the M2 money supply versus the past decade's 6% trend growth. As Milton Friedman famously observed, inflation is ultimately the result of too much money chasing too few goods. Higher energy prices can temporarily push the CPI higher, but they do not create sustained inflation by themselves. When consumers spend more at the gas pump, they have less to spend elsewhere. In that sense, higher energy prices reshuffle spending across the economy. They do not determine the overall inflation tide. That is driven primarily by the money supply. For example, in 2020 and in 2021, the money supply surged by more than 40%, helping fuel the inflation that followed. Today, money supply growth remains well below its historical average of roughly 6%, suggesting that inflation should return to a more moderate path once the current conflict subsides. And as a standard disclaimer, this video is for educational purposes only and is not intended as financial or investment advice. If you'd like professional assistance with the management of your portfolio or your retirement income planning during these trying times, you can connect with us through our website at www.snellerfinancial.com or connect with us through one of our many social media channels. My name is Ron Sneller, and I hope that you found this information helpful. I've been in the financial services business for more than 13 years, and I have happy clients in 47 states. So book a free consult to learn how I can help you. This has been another edition of 3 for Thursday. I hope you found it valuable and informative. Thanks for tuning in, and we'll see you next time.